Alright, everybody, it is Saturday, February 3rd, 2024, and this is our review of the week for precisealgorithmtrading.com, and a happy belated Groundhog Day. So, this is our website, and every now and then I like to highlight it. If you go here to the algorithm trading systems, there's some write-up here on how this stuff works. This video here goes through some old examples. I need to probably update it one of these days. It's my audio quality and a number of other things have improved since then. We've got some tools that are available on the website, and we have other tools that I haven't made available yet, but one of these days we just might. So, but the daily review tab is really where we hit the obviously the daily review, and there's an archive in there, and it all ties back to a YouTube channel as well. So the terms I do want to call out: trading is personal activity, so understand your risk. We're not trading for you. Nothing in this thing is intended to be that way. This is all about just education, and you're on your own, so make sure that's real clear. And we'll hit stockcharts.com in a little bit, but let's dive in and look at our automated trading systems. So this is the YM, and it's the that's the Dow futures contract, and this is 6 months worth of data. We've been in a decline lately, a little pullback here. You can see these things happen here, 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 here. We're in, this is a relatively deep one, but it's similar to this one back here, and hopefully we're starting to come back out of it. So if you look, these are our results for the second. So we had mostly winning trades, and it's unwinding some of these losers from the past week. And so that's how this works. So, and on a this is over a year's worth of data. So really this is just adding up all the trades, the results of the trades for that period of time from 11/1/2022 until 2/2/2024, and you see this is the net gain, and it's actually shows the highs and lows as well. So, and it comes off of this zero down here. So if you start out, you have to be able to have a large enough account size to handle the drawdowns that happen. These may not look significant, but this last drawdown here is $13,000 or something like that, maybe 10. But so you have to be able to manage or basically suck it up for 3 to 4 times that net drawdown, so that you got plenty of money in your account to be able to take it. So if the largest drawdown, and I'll actually dive into this down in the bottom with looking at an example in the NASDAQ, but if your largest drawdown is, say, $20,000, your account needs to be 3 times or 4 times $20,000, $60,000 or $80,000, to be able to withstand that. Because if you get beyond that, then the market won't let you trade, your broker won't let you trade, and you'll be basically washed out. So, and I don't want anybody blaming me for that, because that's just not managing your account the proper way. And let's look at this one. So this is the Russell 2000, and you can see this is a pretty deep drawdown here in the scheme of things, but we have them all the way along, and this one actually probably could still use a little bit of work to try to manage some of those drawdowns and get them to be less. And what's it take to do that? That's what we do. We go through and run back scenarios, and either add something or take something out of the algorithm that makes these dips uh, hopefully less. So right now this is the best that we've come up with so far, but these things can, they can be improved over time. It's just a matter of more work. So what do we got here? The Russell in 2-2 was, you know, back and forth, wins and losses, more losses as far as dollar value than gains, but it's 50-50 on actual wins versus losses. So there's a lot of math that goes into this, and the overall driver here is what's it look like on a longer term basis. This is from 10-2 of 22 to 2-2 of 24. So you can see that over a year's worth of data, your net gains are in the neighborhood of a little over $100,000 with 3 contracts. You can just trade one contract, and then you just divide everything by 3, or you can trade 10 contracts, and you have to multiply everything by 3.3. So this is the NASDAQ that we're running now, and this is back data from the 6 months. So, and we've had a drawdown, and we've pulled back up a little bit out of it, but then at the end of the trading day we had a little bit more. So this is literally what this looks like. Losses and then a win, and then a losses and a win, and losses and maybe a few wins, and then you have some losses along the way, and you just want this thing to come back up. So our trades from 2-2, you can see them right there, and these are long and short. They go both directions for the market, so that you basically can take advantage of either direction. If the market's really bullish one day, then hopefully you can take advantage of that. Like this one right here from 2-1 was a $5,000 trade, and the only thing that stopped it was the end of the day, which is EOD. So, and then here's a short entry on what was turning out to be a pretty bullish day that it resulted in a stop loss. So, but along the way you had a nice trade there. Was a short I'm sorry. Actually, that was a long entry followed by a short entry, like a flip. So, and then here's another short entry stop loss and a long entry stop loss. So this is something I'm diving into a little bit to see if there's any way to reduce the amount of stops, and I won't I won't accept deeper pullbacks in order to get that. Although there's a real possibility that I could reduce stop losses by just letting it run a little deeper into the losses, but that just doesn't fit the way I like to trade. So it's kind of a trade-off is what you have to deal with, is the number of stop losses versus your equity curve going straight up like this. Generally, I mean, it's not straight up, you have these pullbacks, but generally speaking this is pretty straight up, and it's kind of what you have to deal with in the market. If anybody has better ideas to get this to be more without dips, ways to reduce dips, I mean, maybe there's some traders out there that watch this stuff that have some tricks or whatever we could add. So I'd be all ears. That's a precisealgorithmtrading@gmail.com is our email address, so you could drop me a note. So this is the from 10-2 of 22 to 2-2 of 24. So that's over a year's worth of data, and you can see here we've got our net result over 400 grand. And then I've been comparing that to the older system right here, which is a little bit of a better net result actually, with more drawdown and more time. This looks very sideways on this graph. However, it's gone, that's a I don't know, $30,000 drop right there or something like that. So, and it's a lot more trades than this one. I don't know if you can see that, but this is, and I'm going to pull up these data points on the left here in a second so we can look at the actual math. So here's the math of the double check that 421. Yeah, this is the math of the one we were just looking at, which has 2,500 trades, 2,568 trades, and then the one that we're running right now has 1,470. So it's really pretty close in net gains versus the other one. This is the trade-off I'm talking about. This one's a little bit technically better, but when you look at the profit factor, which is wins versus losses, um, this one has a 1.34 all in, and this one has a 1.41. That may not seem like much, but this one's 1.67 on the long trades and 1.2 on the short. This one is 1.44 on the long trades and 1.21 on the short. And this one, literally, this is a great line to look at average trade net profit. So every time this thing trades, if it's long all in, you're making $272, and all in for if it's short, you're making $83 for a total 169 versus 286 for 465 to the upside and 141 to the downside. Let's go back to this for the sake of understanding. 1,470. If your commission is $3 a trade, then it really can pile up if you only do 1,470 trades versus 2,500, almost half. So you can slow this video down or stop it and look at some of this other data, but this is literally how this thing goes together. This trading system has 8 wins and 6 losses in a row. I'm sorry, 8 wins in a row on the long side, 6 wins in a row on the short side, and it has 10 and 9 as far as losses in a row, consecutive losing trades. So this one here is really similar, but it's 10 and 19 instead on the losing side. So those might sound daunting, but at the same time, it's one of those things when you're looking at a really nice equity curve, like either one of them actually, it doesn't really matter as long as you're managing your account value properly, like I was talking before. And then here's the drawdown section. This is the first algorithm that we were talking about. 34,000 net in the max drawdown for the day. And this is 1 year, 3 months worth of data. Almost 4 months worth of data. And I'm just looking to see if there's anything else here that really want to call out. Max trade drawdown, this is per trade. That's based on the stop loss that I'm talking about. And then you compare that to this one, which is 27,000. And that's interesting. 2250, 2250, and 1560 versus 2250, 2250, and 1125. So a little bit better on the short side, actually. And that's enough for that. So again, there's other things I may be able to do to tighten these things up a little bit, but I don't think we're going to get much better than this, frankly. They've been through a lot of testing and results comparison. Diving over here to our manual trading systems. So this is the weighted 30 period moving average. And it sort of almost doesn't matter if you use a simple 30 period moving average versus a weighted one, although I've done enough back testing to see that the weighted actually is a little bit better. That's this green line right here that turns red to green. The weighted is just better as far as the overall numbers and performance goes, which makes sense. It puts more value on the recent price versus the previous price. It's similar to a exponential moving average, but different. And what are we looking at here? The S&P 500. I went ahead and threw up the RSI2 and the fractal energy numbers on these two charts just to kind of keep an eye on them. And then something I added last week that I use regularly is, is their 30 period moving average moving higher? And if so, it's green. And is our longer term moving average, which in this case would be a weekly moving average, is it also green? And all I did really there was multiply the a factor of 5 to the standard moving average. It's a little bit more than that, but it gives me not exactly what the weekly looks like, but it's a pretty good proxy. And it does the same thing for the hourly to the daily, because there's actually 6.5 hours in a day. So 5 times this chart is similar enough to what the daily chart looks like. And that works for really any time frame. If I go down to 15 minutes and 1 hour, it's showing us that we're bullish on both time frames. So, and if I turn off the futures, turn off the extended hours, and don't start the aggregations at the market open, then it looks more like that, and it's still the same. So, and that works also for, let's look at equities the same way. And you can actually see here that, well, that's interesting. Well, 15 minutes to the hour, it's showing us that if we actually, this is, obviously there's 5 periods of, uh, if you look at 5 times the 15 minutes, apparently it's green, so that moving average is moving higher. But at 4 times, which is what we're looking at over here, it's not. So, uh, but let's go back to the daily, so it's just less of a mess, and the hourly, since that's really what we trade. And you can see we're down on the 30 period right there, and we're up still here. And it's showing us that we're up on the 150 period, which is the good enough proxy for the daily. So, hope that makes sense. Something to look at literally in this position that I have live right now is, since it's crossing below here, I could move my stop literally to this point right here, or I could pick this one right here instead of where it is and adjust my risk to meet that stop. I would actually probably pull it to this one, because that seems to be, if you look left and right, of the two dots to left and right, this seems to be the more major of the stops than this one. There's no right answer or wrong answer there. If I pull the stop up to here, that's fine, but if I pull the stop up to here, that's also fine. And if this doesn't come down and take it out, then it'll continue moving higher. If it does come down and take it out, then it could very well gap lower and take out either one of those, or it could just walk lower and take out the one right here that would never taken out here, and then it could reverse, and I could have stayed in the trade if this is the more major pivot, and it could reverse and go higher from here. So that's the trade-off I'm talking about, that you have to look at and get yourself to where you're just a consistent trader, and then never look back is another thing, because there's plenty of other opportunities. Even if it takes this out, and goes back the other way, just who cares? I mean, it's actually protecting profits at that point. That was a long, deep dive. Sorry about that. Close this thing down. Why is that showing up like that? So here's our Russell 2000, and um, we're in this really back and forth section right here. So we've pulled up higher. We've changed direction as far as polarity goes on the market. It was higher highs and higher, or lower highs and lower lows, and we've come back to higher highs and higher lows. And now we're in this. That's either a more major lower high to that one, and we could go down, put in a lower low. But something that, if you really study the markets, there's moves like this that are impulse waves, and then these are corrective waves, and you can get another impulse wave coming out of it, which is really common, which turns this into a flag pattern. And I'm going to show you that by just drawing. I think that's the right tool. Across that edge, pull it down like this. And so these are channels, and this thing can walk down this channel. What you expect to see is this pivot broke higher than the previous and changed polarity somewhere back in here. And then you walk through this channel until you put in a higher low, and then you break out of this channel to the upside to go possibly put in another impulse wave. Now, the second impulse wave may not be as large as the first one, but from basically what I'm trying to say is, I think from my vantage point, in this system, you can see the long term up here is at 150, and it's green. The short term is red, and I'm expecting at some point here to put in a higher low, and then to come up here and break this upper trend line. Because otherwise we'd have to come all the way down here, take out this pivot to the downside, and that would be a larger term bear market. And if that happens, this 150 period up here label would absolutely have to flip to red. So let's look at that on a weekly chart too, and you can see we have a break in polarity on the weekly chart. And so you can also see that we're clearly green on the moving average. So this thing's got a lot of potential to the upside, is really what I'm trying to say. There's nothing written in stone that can't go the other way. The world could fall apart, and we can't control that. Here is the Dow, and it looks to be breaking higher again, and we're in higher highs and higher lows on the hourly time frame over here. We're up against the upper reversal zone on the 2 period, or the 2 this is 2 average true ranges away from the mean. So you can see this oscillator goes back and forth. I should say the price goes back and forth between the 2 lines. I can put 3 lines, or the 3 ATRs up here. I can show you that it does that too. But the 2 is kind of to know where the like this point here on the Russell, or I'm sorry, on the Dow here, is where if you were long the Dow right now, you'd want to pull your stop up to here, and it happens to coincide pretty closely to the 2 average true ranges to the low side. And that's not a coincidence. You can see if you pulled your stop over here, it'd be underneath that as well, and even back here. I'm just saying, if you look back in time, these pivots to the downside and the 2 average true ranges work out pretty well for a general stop area. The NASDAQ pulled back up pretty well on Friday. That's The news that I think hit the big news that happened, I think, was Facebook. Let's look at it real quick. META had a giant earnings day, and there's one or two others. And I heard something that like this is a record, 20% on earnings must be a record. I don't know if that's true or not, but that's a giant deal. It's Facebook's a really large cap stock anyway, so that'll help move a market, which is part of the reason why the Nasdaq uh, punched so far higher. Facebook might even be in the Dow. I'm sure it's in the S&P. You can Google all that stuff if you want. Speaking of Google, I think they had the same thing, but not nearly as much. Nope, they actually gapped lower. So Google didn't have as good of results after their earnings. Apple also didn't, but that's pulled back a lot higher after it hit this lower zone, the 2 period moving or average true range to the downside. Amazon. These are just stocks you can keep an eye on to kind of help you kind of know what's going on in the overall markets. Facebook, Amazon, Netflix, and Google are the FANG stocks, and you can see that had a nice gap higher. Not 20%, but a nice gap. NFLX, Netflix had a gap or had a decent earnings the other day, and it just continued to stay in that upper zone because of the other uh, Nasdaq stocks. So, all right, I'm going to get off that. Here's the transports. They're in that same back and forth kind of a zone, but still looking pretty bullish overall. And oil broke down and it actually gapped through or traded through my stop. I pulled my stop up on the hourly because I was positive in oil, and it stopped me out. So, and that's fine. I'm going to continue to watch this because it did change polarity, I believe, here. It could have been a fake out, but next chance I get to get in, I'm going to probably do that. So if it goes bullish again. Now, at the same time, I don't like that all three tags are red. So if we look and open this up and look at it on a weekly basis, I'll call that monthly is moving higher, and the weekly still looks pretty weak at this point. But this is a break of structure to the upside as far as change in polarity. And our stop, if we were actually going to trade it off of a weekly chart, would be all the way down here at 57.29 or thereabouts, or call it 56, somewhere between there, 56 and 56 and a half and 57 and a half. So let's look at the monthly, just because we're here. Yeah, we have not had a break really in polarity on the monthly from the look of it. Let's flip that back to here. So that's the kind of thing you can do. So I'm not real excited about oil at this point, especially since I just got stopped out. Gold, GLD. I went ahead and got long when this thing pulled back a little bit. We got basically in at where I would have entered the other day with a stop pretty much right underneath there. And if I'm wrong, I won't be wrong for very long. So that's enough for today. Let's go to stockcharts.com and wrap this thing up with the bullish percent indexes. The industrials added 2 O's to the downside. I wonder if they didn't move here, or if that's just showing today. Let's look. No, they didn't. That's interesting. So the industrials added two O's to the downside and came back up into that pattern. So they effectively didn't move by the end of the day, except they did tack on O's. So they're showing strength and weakness. Is kind of a weird way of looking at it. The NYA added an O to the downside and only went down 0.1%. That 2 is basically it's marking that it's February, and it's the first time it moved into something, so it's an O to the downside. Transports didn't move on Friday. The NASDAQ down 0.21%. The S&P 500 went up by 1.22%. The S&P 100 it went up by 1.56%. The S&P oops, that was the S&P 100. The S&P, I'm sorry, the NASDAQ 100, the NDX, added a new O to the downside and went down 1.35%. So we're still, I think, in a pretty shaky spot. Let's go back to here real quick and look at the VIX. So when the VIX really picks up like it did back here in, let's call it October, that's when the market really fell. Let's undo this real quick. Make this a daily chart and put up the SPX. So there's your October when the market was really falling. And you can see we pulled up a little bit. If you can't tell on the left, on the daily chart over here, it's marking time the same way as it is on the right, which is the S&P 500. So while this thing was rallying, the VIX was actually, the VIX fell right here. And when the VIX, or when the S&P really fell there, starting on 10/18, the VIX was actually moving quite a bit higher. So you can see that the VIX actually helps us understand where we're at with the markets. Now we've been in this lower zone here, but you can still see the back and forth that also sort of, mostly matches the overall market. And there's another little hidden trick that goes on when the VIX gets above I think it's 2.5 average true ranges, and then snaps back in, closes above, I should say, then there's a good chance that we're going to get a market reversal, actually back to the upside. So I'll try to show that at some point. I've got an indicator for it, but it's not that important. It's just another indication of basically some tricks in the market that we can use to kind of understand and validate our trading direction. Most of the time, our trading direction is going to be positive, but there's going to be times when we're going to need to flip and be validated to take the short side of the market, or to back off and just go to cash. So we're not in that right now, or at least not yet. And that's why we look at all this stuff. So I'm going to leave you guys for the weekend. Today was a long one, and it's really for the sake of the education that I was talking about. So have a happy rest of the weekend, and we will catch you next week.